The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Singapore's equity market is getting a fresh boost. The Monetary Authority of Singapore has rolled out its equity market development program aimed at deepening the market and broadening participation. And as part of this, Fullerton Fund Management has been appointed among the first batch of asset managers and has just launched the Fullerton Singapore Value Up Fund, the very first retail equity fund under the initiative. The fund focuses on Singapore-listed companies across all market caps with a high-conviction, catalyst-driven approach to unlock shareholder value. So to find out more, I'm joined now by Robert St. Clair, who is the Managing Director and Head of Investment Strategy at Fullerton Fund Management. Robert, welcome to the show.
Indeed, good afternoon. Pleasure to speak with you.
Thank you so much for joining us. Well, Robert, Fullerton has just launched the Fullerton Singapore Value Up Fund. It is the first retail equity fund under MAS's Equity Market Development Program. Now, what does this mean for Singapore's equity market, and why is Fullerton taking the lead here?
Yeah, well, I think that the key thing is, what does it mean for Singapore's equity market? And I think the thing that's top of mind for investors, I would say at this juncture, is that all of the stars are aligning. So if we think about from the fundamental perspective, equities in Singapore have been doing very well because of strong earnings growth last year. And, of course, that has continued into this year, and it's showed up in returns. And as you pointed out, from the policymaker perspective, we have significant initiatives from the MAS on the demand side of the equation, but also from the government in the budget in February from the supply side of the equation, where they have given tax incentives for more firms to list, as well as tax incentive boosting the key themes that Singaporean investors really like, which is the whole productivity story, the clean energy story, and of course what's happening with manufacturing. So I would say across the board, what's important for investors now is that we have policy actions that are pulling all the levers, and we have strong fundamental growth that is coming through to the Singapore market, both domestically and externally. So it's a very exciting time.
Definitely. Well, investors have been watching Singapore's economy closely. I mean, growth has been steady, the SGD remains strong, and corporate earnings are improving. So, Robert, what is Fullerton's outlook on Singapore equity market right now, and how does that underpin the timing of this fund?
Yeah, indeed. So we became more bullish on Singapore equities about a year ago. And that was a time where we believed that if we think about the economic performance for Singapore, it was materially stronger. GDP growth was a lot stronger, tracking up to 4% at the end of last year. But there was this decoupling from earnings growth performance. I think that a lot of analysts were too pessimistic in terms of the earnings that was going to come through. So a lot of that has started to show up in returns, and that are positive for investors going forward. And I think the other thing that was key to us, we did a survey of Singapore's investors last year, and they were quite savvy and forward-looking. At that juncture, they ranked Singapore equities as the key risk asset to buy. That's more than a year ago and before these policy initiatives happened. And one of the key reasons that they like equities at that juncture, and that's what I guess underpins our bullish outlook, is the key themes that Singapore is strong in. So it's productivity, it's manufacturing, especially to global demand, because there is strong demand in Asia as well as Europe and, of course, the US. And the other key one, I guess, is if we think about consumerism in Singapore, that is also coming back stronger. We have strong income growth and more tourism. So it's kind of across the whole spectrum of the sectors that investors typically like, is what's driving the bullish outlook going forward. And we do believe that next year the market is still pessimistic on earnings growth expectations. It's tracking around 7%, which is around Singapore's historical average. But the key thing at the moment is that economic performance and growth is above average for Singapore. So if that can continue into next year, then indeed earnings growth has more upside to come, and that can be rewarding to investors.
So where do you see the most attractive opportunities in terms of, sectors or themes within Singapore equities?
Yeah, so I think that the flagship for this year has definitely been in the industrial space. That has been a key source of alpha. It has outperformed the market aggregate. And again, it's a reflection of Singapore's strong productivity, because a lot of people forget just how automated Singapore is. It ranks number 2 globally in terms of the deployment of industrial robots per worker. That's been very important in terms of boosting revenues, keeping costs down. Of course, inflation is very low in Singapore, and there is strong external demand. So that's been very helpful for the industrial side of things. When it comes to the communications sector, they are benefiting again from Singapore's productivity enhancement and low inflation. If we think about consumerism stocks, what's going on there, of course, is that disposable income growth has been strong. And because inflation is well contained and well controlled, it's actually quite low by global standards, it is actually helping to bring consumption forward for households, and that has been quite rewarding for the consumption sector as a whole. And then, of course, when it comes to financials, they are doing well because interest rates are coming down across the board. So their net interest margins are still being defended. And of course, lower interest rates does mean it's a good environment for real estate. And that's, of course, the other sector that is benefiting from the lower interest rates. And of course, the strong loan growth. Loan growth is running above GDP growth at the moment, and that's positive for real estate as well as for the banks. So the key takeaway is that, all the key sectors are doing very well, but each one has different fundamental drivers that are positive, and that can appeal to investors because it does give you some diversification.
Well, I believe the fund invests, across large, mid, and small cap Singapore-listed companies with a focus on catalytic growth and shareholder value creation. So what differentiates the Fullerton Singapore Value Up Fund from other equity funds in the market?
Yeah, so the key features that makes Fullerton special and different is that for us, we really focus on a partnership, active management regime with our investee companies. So it's very much about partnering them on their journey as they continue to follow a strong business growth model and can unlock further shareholder value over time. So that's why we kind of want to hold hands and work together with these companies on that journey, because a lot of it will come down to changes in their operating strategies over time. So, for example, they can have a very strong business growth model, but they may find that some of their assets are not giving the kind of return that they would like for their revenues. So they may indeed diversify or buy back some more of their own shares to optimize their balance sheet further going forward. So that's the active management and the partnership part of this fund that makes things quite different. And the other key feature that is different is that we are broadening our horizon in terms of looking at all the companies across the capital structure, and that has the advantage to investors that you can get greater exposure to the mid caps and to the small caps, because those are the types of companies that are likely to be most exposed to consumerism or to the real estate sector. And often investors like those sectors, but they just can't get exposure. So one of the key benefits from Fullerton's fund is our active management allows us to do that, but we also want to very much partner with our investee companies along the way to help them on their growth journey.
Well, the fund's strategy focuses on catalytic growth and shareholder value creation. Yes. What's the catalyst-driven approach here? And what types of corporate actions or events are you targeting as key drivers of shareholder value?
Yeah, so the key thing to keep in mind is when we talk about catalysts, there's obviously the fundamentals of the business model. So your productivity, your revenue gains, your market share, your market power, all those things that drive the strength of your business model. That's what we mean by the fundamentals of catalytic growth. When it comes to more of the micro or business-focused areas, and that's where our partnership with our investee companies is really important, that really comes down to what operational changes may a company make over time. So the example that I was kind of highlighting earlier is that in terms of maximizing your revenue, you will look at the returns that you're getting from your assets. Perhaps you can diversify to higher yielding assets to boost your revenues along with your cost controls to boost your earnings, and that could result in you perhaps doing more share buybacks. So that would be, if you like, the corporate event that would happen over time along this growth journey. So it's not a case of targeting particular types of actions, but rather it is partnering with our investee companies and helping them along the way through the different operational adjustments that they may make as they continue on their growth model and seek to optimize the returns to shareholders.
Very interesting. And I believe the portfolio is high conviction, holding 20 to 40 names, actively managed to outperform the FTSE Straits Times All-Share Index. Why take a concentrated portfolio approach, and how does this align with investors' appetite for risk and returns, Robert?
Yeah, so that's a very good question. And again, that's one of the things that we see quite beneficial at this juncture. As I said earlier, because so many of the sectors in Singapore have favourable fundamental drivers, the only way an investor could get tangible exposure to those different stories, whether it's real estate or whether it's communications or consumerism or manufacturing or financials, is to actually broaden your horizon and look at those different options across mid-caps and smaller caps. Now, investors may think, well, does that give me some diversification benefit? Well, yes, it does in two ways, because firstly, you are getting different sector drivers. So the things that are driving real estate and consumerism is low interest rates, the strength of the domestic economy in Singapore. The things that are driving more of the manufacturing is not just the strength of the Singapore economy, but also the strength of external demand and economies that way. And the other thing that we have noticed, of course, by following that strategy where you have a broad exposure to the different sectors in Singapore, is that as Singapore's returns have shifted into double digits, which has been a trend for the last 5 years now, the correlation, at least over the last year or so, with returns in developed markets has actually fallen a lot. And part of that reason could be because Singapore doesn't have a very high direct exposure to the AI story. We all know about the AI story. It gets all the headlines in the US. So Singapore doesn't have that direct exposure, but it does have, of course, the indirect benefits that come with it. So it comes back to the point I made earlier that manufacturing in Singapore is benefiting from AI and industrialization and mechanization. So too is healthcare. Another key thing that the government talked about in the budget in February was biomedical and the innovations that are going on there. So the key thing, I think, is that investors can get this diversification by taking a broad view at Singapore's sectors, and it can actually give you some valuable diversification if you would like other opportunities beyond the headline of the AI story, because Singapore is benefiting in different ways more indirectly in terms of the performance of other sectors and in terms of productivity.
All right. Well, definitely some interesting insights here. But how do you balance between, established blue chips and opportunities in small and mid-cap companies?
Well, I think that comes back to this juncture being so special because the stars are very aligned. So if we think about what policymakers are doing to encourage the listing of small caps, there is now a significant tax incentive for new listings as well as existing firms to issue more shares. That's a very important supply-side shift that will motivate more investor participation and, of course, better performance for these companies over time. The other key thing, of course, what policy is also targeting is greater investor education and more in-depth research into the smaller cap companies. And again, this will help build investor confidence and such going forward. And I think the third key factor, which makes things just so special, is the Singapore economy is firing on all cylinders. So whether you are a small cap or whether you're a mid cap or a large cap, you are not missing out on strong performance. It's just the key differentiating factor is that the drivers are quite different. So for the large caps, half their revenue comes from Singapore, half their revenue comes from the external demand, which is strong at this time, which is very good. For your mid caps and your small caps, you get a bigger exposure to real estate and to consumerism, and those are facing robust fundamentals because interest rates are coming down, income growth is strong, and inflation is low. So all of those things can help boost the performance of your company regardless of where you are on the capital structure.
So do you think this program will help attract more IPOs and secondary listings in Singapore as well?
Indeed. So I think, fundamentally the real game changer was what the government introduced in February. Those tax incentives are very important. A 20% tax rebate for a primary listing, a 10% rebate for secondary listing or issuing of new shares. There was also tax incentives for fund managers to come and list in Singapore, and for fund managers, of course, to manage significant amounts of risk assets. If we look at the market chatter and what SGX has suggested, the IPO pipeline from now until the end of next year is running at about 30 companies. So that's very positive and very good news, I think, for investors and policymakers alike.
Well, the fund offers accumulation and distribution share classes, appealing to both growth-oriented and income-focused investors. So overall, who is this fund best suited for, Robert?
Indeed, I think there is, as you pointed out, there's something for everyone. So if you are an investor who is happy to reinvest your dividend streams over time, you don't need to touch the money today. You may want to keep it for 10 or 15 years and just let those capital gains accumulate over time, take advantage of the magic of compounding. Then you will want to, not go with the distributional option. If you will favour the accumulating type funds. Whereas if you are wanting an income stream, you want to receive your dividends, you don't want to reinvest them, then I guess you're going to favour a distributional type option. So I think, all the options are there across the board to cover any investor preferences.
In a world where global markets often dominate investors' attention, why should retail investors look closer to home and invest in Singapore equities?
I think there's always an important role for diversification. So investors should always look at global markets and domestic markets. And I guess the other slice of diversification is when you're looking at your local market, do you want to have a diversified view across the sectors? And that's very important because the drivers of the sectors are different. One of the things that came out from our investor survey last year, Singaporean investors banged the table and said, look, we like investing in Singapore. We have a significant home bias to Singapore. We have achieved double-digit returns for the last 5 years on average. It's been a great diversifier and an important option. So I think investors always do their homework and look at diversification, but there's international diversification as well as sector diversification at home. Both of those things are important. And the last thing I would think that is important to Singapore investors that they often lose sight of is that the Singapore dollar is very strong. Now, if you're a foreign investor, you want to invest in a country where the currency is strong. So for foreign investors, it's a no-brainer. Singapore is always on the radar. For local investors, they shouldn't lose sight of the fact that when the Singapore dollar is strong, that's an extra piece of alpha that you are getting on top of your equity return because your global purchasing power of what you can buy in the rest of the world from your equity returns is rising. So I think, the key benefits for a local investor in Singapore is that, yes, you can get diversification across the sectors and you have the added benefit of a strong Singapore dollar.
Some great insights from you there. Thank you so much, Robert, for joining me today.
Indeed. Thank you. Pleasure to talk with you.
Thank you. That was Robert St. Clair, Managing Director, Head of Investment Strategy at Fullerton Fund Management. This has been the Wealth Tracker with me, Hongbin, Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3